Turkey just panicked sold 58 tons of gold in 2 weeks. Gulf sovereign money has been moving bullion out of London vaults at a pace I have not seen in a very long time. Oil has been ripping higher. And while most people are staring at the gold chart and concluding something must be broken, institutional money has already started flowing quietly into 2 corners of the market that financial television barely mentions. That is where I want to begin, because if you are within sight of retirement, this is not just another market story. It may be your last big wealth opportunity before you stop earning and start depending on the portfolio itself to carry more of your life. That changes the meaning of every decision. When you are 35, you can recover from foolishness with time. When you are 58 or 62, time is no longer standing beside you in quite the same way. A bad decision near retirement is not just a bad number in an account. It can become a changed life, a smaller home, a postponed plan, a retirement delayed by years. That is why I take windows like this so seriously. And this is a window not because everything is wonderful, because everything is conflicted, because fear is creating mispricing, because forced selling is making strong long-term ideas look temporarily weak, because structural change is pushing money into places the crowd still thinks are too ugly to be real opportunities, and because innovation, when it lines up with capital scarcity and corporate desperation, can create the kind of upside most people only notice after the first half of the move is already gone. That is the framework I want to give you. Not a list of hot tips, a framework. Because if you understand the framework, you do not need somebody to shout a ticker at you every week. You can begin seeing these setups before they become socially obvious. That is one of the great differences between retail behavior and institutional behavior. The crowd wants the name first and the logic second. Serious money wants the logic first, because if the logic is strong enough, the names can be found and the positions can be built before the television segment arrives. The framework I use in environments like this has 3 layers. The first layer is forced selling. That is when institutions are not selling because their long-term thesis died. They are selling because they need liquidity. Now they have a margin call, a currency defense problem, an emergency funding need, an allocation mandate, a redemption problem, or some other immediate pressure that has nothing to do with the long-term value of the asset being sold. That kind of selling is one of my favorite kinds to study. Not because I enjoy panic, because panic causes temporary stupidity. Forced selling can push an asset below where its long-term fundamentals justify. And if you can identify the difference between a broken thesis and a temporary liquidity event, you can buy into the dislocation while everybody else is confusing urgency with insight. The second layer is structural change. That is different. Forced selling is temporary. Structural change is longer. Structural change is when the world itself is shifting in a way that creates lasting demand for a sector, commodity, a type of business, or a very specific form of cash flow. These opportunities do not depend on a bounce next week. They depend on the world being different 2 years from now than it was 2 years ago. That is where large wealth is often built, because if you align with structural change early enough, you are not just buying a dip, you are buying the front end of a new demand curve. The third layer is innovation. This one excites people the most and ruins many of them because they fall in love with the story and forget the discipline. But innovation can be a gold mine when it attracts institutional capital before the public fully understands what is changing. New technology, new productivity, new economics, new acquisition waves, new cost curves, new tools that make old businesses obsolete or radically more profitable. These things matter, but only when you separate the real innovation from the promotional fog that usually surrounds it. Most investors only know how to look for one of these layers at a time. They know how to chase a hot story, or they know how to buy a panic, or they know how to talk vaguely about secular trends. Very few know how to recognize when all 3 are appearing in the same environment, sometimes even in the same broad area of the market. That is what makes this moment so interesting, because right now I can see all 3, and if you are close to retirement, that matters more than it would have mattered 10 years ago. Because you are no longer just trying to maximize upside. You are trying to make sure the next decade belongs to you rather than to the people who were willing to think more clearly while you waited for comfort. So let me take these one by one. The first layer is forced selling, and the clearest example I see right now is in gold and silver. Now, I know that sounds odd to many people because when they hear forced selling in metals, they think maybe the thesis is broken, maybe the world suddenly stopped caring about monetary debasement, deficits, reserve diversification, currency distrust, and central bank buying. But that is not what this looks like to me. This looks like an emergency liquidity event. Turkey sold an enormous amount of gold in a very short period. Gulf wealth has been moving bullion. Other holders under pressure have been liquidating, not because they have lost faith in hard assets, but because they need cash in a world where war, oil spikes, currency pressure, and market stress are forcing immediate choices. That is not the same as saying gold is structurally weak. It is saying some holders are being forced to sell something valuable because their short-term problem is more urgent than their long-term view. That distinction is everything. If a farmer sells part of the family silver to get through a hard season, it does not mean silver stopped being valuable. It means liquidity came first. That is what I think the market is misreading. When I study gold and silver right now, I do not see the long-term case disappearing. I see a temporary event pushing down the price of an asset whose long-term case remains deeply intact. The debt burden is still there. The deficits are still there. The pressure on fiat systems is still there. Central banks still want more gold, not less. The dollar may have episodes of strength, but the long sweep of over-indebted monetary systems has never been especially kind to paper credibility. None of that has changed because a few countries and large funds needed emergency liquidity. This is why I say forced selling is the first layer. It creates the discount. It does not kill the structural demand. Silver is even more interesting because silver is not only monetary, it is industrial that matters enormously. Gold can rise on fear and monetary distrust alone. Silver can rise on that and on industrial demand. It is more volatile. Yes, it is emotionally harder to own, yes, but when the selling is mechanical and the long-term demand has two engines instead of one, that is the kind of asymmetry I pay attention to. I am not telling you to run out and buy metal because some man on a screen used a dramatic phrase. That is not how I think, and it is not how I want you to think. I am telling you to understand the nature of the event. If long-term demand is still there and the drop is being caused by people who are liquidating out of necessity, that is one of the few times lower prices can be more of a gift than a warning. That is the first opportunity. Now, let us move to the second layer, structural change. This is where the story gets much less fashionable and much more profitable. The first place I see that structural change is coal. Yes, coal. The thing polite investors have spent years pretending no longer matters because it offends the social mood. Markets do not care about the social mood when physics is involved. If oil stays high and natural gas stays expensive, countries and utilities start looking again at what can actually generate power at the margin. Europe can hold all the conferences it wants. India can issue all the statements it wants. But when supply gets tight and costs get ugly, the system falls back toward what is available, scalable, and economically viable. That is often coal. And because coal has been so hated, so underinvested, and so socially poisoned as an asset class, supply has not exactly been built for a surprise resurgence in demand. That is one of the oldest setups in markets. Demand surprises to the upside while supply was discouraged for years by politics, fashion, regulation, and underinvestment. When that happens, the price response can be far more violent than people expect. This matters in two ways. First, coal can substitute at the power generation level when gas and oil become uneconomic. Second, coal matters through steel. People forget the second part because it is less flashy. They want every energy story to be about the barrel price on a chart. But coal also sits inside the industrial backbone. Steel does not appear because central banks make speeches, bridges, defense systems, rail, heavy infrastructure, and basic industrial construction all require steel. And conventional steelmaking still leans heavily on coal. So if you have an environment of higher energy prices, more geopolitical stress, more defense spending, and renewed infrastructure urgency, you suddenly have a setup where a hated, capital-starved sector begins looking much more important than the moral theater around it would suggest. That is the kind of structural shift I love. The opportunity is not in telling yourself coal is beautiful. The opportunity is in recognizing that markets often price morality and social narrative much faster than they price physical necessity. Physical necessity always wins eventually. That is why I do not care whether the story is fashionable. I care whether the demand becomes unavoidable. When it does, neglected sectors can rate with astonishing force because no one built enough capacity and very few portfolios are positioned for the possibility. That is where the money flows first. Quietly, institutionally, before the crowd is emotionally ready to admit that the thing it was taught to ignore is suddenly useful again. Now, the second structural shift sits in the same general field, but it is distinct enough to deserve its own sentence: natural gas and LNG. If Gulf LNG flows are threatened and alternative exporters are one of the few systems able to step in, then gas infrastructure, LNG exporters, and their supporting chains become more valuable. This is one reason I always tell people to think in second-order effects. The crowd stops at oil because oil is the most obvious headline. Serious money asks what else tightens when the same bottleneck gets hit. That is how you find opportunity before it becomes obvious. Now we come to the third layer, innovation, and the place I see it most clearly right now is biotech. This is the kind of sector that can make people rich and ruin them in the same quarter if they do not understand what they are doing. So I want to be especially precise here. Biotech is not a playground. It is not a mood trade. It is not something I would ever want anyone to approach with blind excitement, because the failure rates are too high and the outcomes are too binary, but that does not mean there is no opportunity. On the contrary, some of the most powerful wealth windows come when a difficult, high-risk sector suddenly gets a massive institutional tailwind for reasons that are concrete, predictable, and urgent. That is what I think is happening. Now, the first reason is the patent cliff. Large pharmaceutical companies are heading toward a stretch where an enormous amount of revenue tied to major drugs begins losing exclusivity. That means generic competition starts taking pieces out of their best economics. And once that starts, the revenue drop can be savage. Those big companies do not have the luxury of simply shrugging and accepting the whole. They have to replace the pipeline. And when a giant incumbent needs innovation faster than it can develop it internally, it starts buying innovation from the outside. That is the acquisition wave. That is where small and mid-sized biotech can suddenly become incredibly valuable. Not because the public falls in love with them, but because strategic buyers with giant balance sheets are forced to look for new assets. This is one of the most reliable ways serious money gets made in biotech. Not by blindly guessing at miracle drugs, by understanding when the large buyers have no choice but to go shopping. The second reason is AI. Now, AI is one of those subjects that causes intelligent people to become religious very quickly, which is usually a sign that caution is required. But inside biotech, there is a real and practical use case. Drug discovery can become faster, modeling can become faster. The cost of filtering bad candidates can fall. The speed of identifying promising pathways can improve. That does not remove risk. Clinical failure will still exist. Regulation will still exist. Biology will still humble plenty of arrogant people. But it does change the economics of discovery. And when you combine a patent cliff with faster discovery tools, you create a world where acquisition, appetite, and innovation productivity begin reinforcing each other. That is why I think institutional money is flowing here, not because biotech suddenly became safe. Because the reward for being right in the right vehicles may be enormous, and because the strategic need on the part of big pharma is real, immediate, and measurable. That is the difference between story and setup. Now, because I am Warren Buffett in spirit here, let me give you the part most people do not want to hear. Biotech is risky, very risky. This is not a place for emotional heroics. Individual names can implode because a trial fails, a regulator delays, the science disappoints, the market reprices risk, or an acquisition that everyone was fantasizing about simply never comes. That is why if you want exposure here, you need either broad diversification through well-constructed funds or exceptionally disciplined sizing in individual names. If you treat biotech like a casino, it will behave like a casino. If you treat it like a targeted allocation to a sector with strong structural tailwinds and institutional buying pressure, then at least you are thinking clearly. That is what matters. Thinking clearly. Now, let me tie these three layers together because that is where the real value is. Layer 1 is gold and silver, where forced selling is creating a temporary discount in assets whose long-term structural demand remains intact. Layer 2 is coal and related energy substitutions, where the oil shock and global power stress are reviving demand in hated sectors that were starved of capital. Layer 3 is biotech, where patent cliff and technological acceleration are drawing institutional money into a sector most people only discover after the first wave of gains has already happened. These are not the same type of opportunity. That is important. Gold and silver are a forced selling setup. Coal is a structural revaluation setup. Biotech is an innovation and acquisition setup. The crowd usually tries to compare everything using the same lens and then gets confused. Do not do that. Each type of opportunity has to be sized, timed, and understood according to its own character. Gold and silver reward patience and conviction about the long-term case. Coal rewards a willingness to own what is unfashionable, while the economics improve. Biotech rewards selectivity. Humility and an understanding that one of the greatest edges in markets is buying where big strategic capital is likely to be forced to act. That is the framework. And if you are close to retirement, you should care about this framework much more than the average 30-year-old, because your margin for major mistakes is lower and your need for a decisive, intelligent decade is higher. This is the part nobody likes to say plainly. If you are nearing retirement, you do not need to hit 10 home runs. You need to avoid the strikeouts that permanently change the rest of your life. At the same time, you cannot afford to spend the next decade sleepwalking through the last major wealth window available to you because you were too scared to learn the framework. That is why I care so much about this moment. This is not about getting rich by Friday. That is childish. This is about seeing a rare alignment of temporary dislocation, structural change, and innovation. Capital flows while you still have time to position intelligently. And I want to say something else that matters. Most people will hear a message like this and still do nothing. They will say it sounds interesting. They will tell themselves they need to study more. They will wait until gold feels safer, until coal becomes socially acceptable, until biotech already had a nice clean run and some large bank puts out a friendly report telling them it is time to pay up. That is how windows close, not with a door slamming. With hesitation, 1 month becomes 3, 3 becomes 9. Then the move is already underway, and people convince themselves they are being prudent by waiting for a better entry that never really arrives. That is why my Wall Street mentors drilled one lesson into me over and over again. The institutions do not show up on Monday morning and ask each other what they feel like buying today. They work from structure, they look at stress, they look at incentives, they look at where forced sellers are appearing, they look at where structural buyers will have to show up, they look at which sectors are hated, under-owned, or misunderstood precisely when the economics are improving. Then they position. That is what I want for you. Not perfect prediction, not emotional excitement, just a better process. If you can learn to ask these 3 questions every time the world gets weird, you will already be ahead of most people. Where is there forced selling that may be temporary rather than fundamental? Where is there structural change that will create durable demand over years, not weeks? Where is there innovation attracting smart money before the public has fully understood what changed? That framework is worth more than any single ticker symbol I could ever hand you, because tickers change, the framework stays useful. Now, if I had to reduce everything I just said to one practical truth, it would be this. The last big wealth opportunity before retirement rarely looks like opportunity when it begins. It usually looks like discomfort. It looks like assets you thought should be up being down. It looks like sectors the crowd hates quietly starting to work. It looks like money moving into places nobody at dinner wants to talk about. It looks like the kind of setup that makes average investors suspicious and serious investors curious. That is where we are, and the test now is very simple. Will you wait until all of this feels obvious and therefore more expensive, or will you do the harder thing and start thinking like the people who move before the crowd catches on? That is the real difference between watching a decade-defining setup happen and actually participating in it. And if you are close to retirement, that difference is not academic. It is personal. It is the difference between arriving at the next decade, positioned for it, or explaining to yourself one more time why you saw it forming and still remained on the sidelines. I know which side of that choice I prefer. I suggest you make yours while the window is still open.